In speaking with Coen van Oostrom, he's founder and chief executive of Edge, the biggest commercial property developer in the Netherlands, and with €3 billion worth of developments in the pipeline, one of the biggest in Europe. He's been a leading advocate of the sector, reducing its emissions to net zero by the middle of the century. So I asked him what he hoped might come out of COP28.
What I know for sure is that there's a lot of businesses here coming together, a lot of NGOs, a lot of governmental leaders that really want to make a push. But the topic, of course, is super complex, and we will see what the big negotiation is going to bring. What I will know for sure is that on the business side, there's a lot of leaders now that are saying, hey, we need help, we need good regulation to move forward. And I think it's very important that that is being discussed at this stage with leaders from all around the world to make sure that we move forward.
Now, your industry, real estate, accounts for 39% of global CO2 emissions. Is enough being done to address that?
I think that within the industry, there's a lot of people working on trying to see how we can do better. There's a lot of people signing up to net zero pledges and trying to move the needle. Then again, if we just look at the production of steel, if we just look at the production of cement and all these other parts that make a building, we look at the operational carbon, we still have a very long way to go, and I think that a lot more work needs to be done. I think it's also what you see here, a lot of European companies that come together and that are leading the pack in changing it. And at the same time, we have to be realistic. I heard a number this morning that 75% of carbon emissions coming from steel are coming from China. And we haven't seen a lot of Chinese business leaders here. And so there's a lot of work to be done in the building industry. And I think that step by step, we're moving in the right direction, but we are too slow.
Now, you were one of a number of business leaders in the industry to have signed a pledge in January this year to reduce emissions by 50% by 2030. What sort of progress are you making towards that?
Actually, we're going a lot faster than what we thought. It turns out that the technology is already there. It also turns out that a lot of our tenants, my company Edge is making buildings, office buildings for the professional tenants. These tenants are now asking for net zero buildings and are willing to pay a premium up to 10, 20% for those spaces. At the same time, what we are seeing is just a small group of developers and a small group of tenants that are doing that. And there's a big part of the industry that has already been built, that have buildings that are not so sustainable and where too little is happening.
Have you been able to reduce costs without incurring too great a cost for the business?
What we found out is that you can already save like 30% of your operational carbon if you just put some sensors in your building and really start to measure what is happening. I'm sure that even your studios that you're working in on Sunday still have some lights on. If you have a couple of sensors, if you manage that in a proper way, it turns out it's relatively easy to already address a lot of those electricity uses in a building. We developed some of that software. A lot of companies are using that now, and I think that's the first step for a very low price to already address some of those emissions.
And more broadly, you've active developments underway in the UK, the Netherlands and in Germany just now. Are you starting to see build costs starting to moderate? Is inflation starting to ease?
Yeah, but we're coming from a point where building costs were really spiraling out of control, and we're seeing now that things are getting back a little bit, or maybe better said that they are staying at least at the same level, and so much less inflation. But compared to 5 years ago, construction is quite expensive. There's a good side to that, and the good side is that everybody will focus a lot more on existing buildings and trying to shape them, modify them, retrofit them into buildings that will become low energy consuming. And I think that's a good way forward, because the embodied part of the carbon, so the carbon in the cement and the steel, is a big part of the problem. And if we use existing buildings and retrofit them, there's a lot to gain.
And when do you expect to see some clarity on the next Dutch government? And what are your hopes for that government?
Well, I think that what we see in the Netherlands is that immigration has become a major topic. But behind immigration is the fact that we seem to be able to only build something like 50,000 houses a year. And that last year we had an inflow of 225,000 immigrants into the Netherlands. I think that the general population in the Netherlands is open for immigration, but does want the government to do a good job on facilitating that. And I think the discussion should be more about how to facilitate that. What does it mean for infrastructure, for housing, etc. Then it should be about who can come in, who can't come in. But we all know, we have seen that at Brexit, that if you don't take care of some of those real issues that really go to the heart of people, that we end up, in a world where people then might vote for a person like Geert Wilders.
Some other business news stories for you now. And UK house prices unexpectedly rose last month, according to Nationwide Building Society. The UK's second biggest mortgage lender said average prices in November were up 0.2% on October. Economists had been expecting a decline of 0.4%. It was the third consecutive month-on-month increase. On a year-on-year basis, prices were down 2% on November last year, representing a moderation from the 3.3% year-on-year decline in October. And that represented the strongest outturn for 9 months. The household appliances tycoon Sir James Dyson has lost a libel action against Mirror Group newspapers over an article published last year in the Daily Mirror. Sir James, a Brexit supporter, was unhappy at an article by the columnist Brian Reid, which accused him of hypocrisy for moving Dyson's head office from the UK to Singapore. Sir James said he had found the criticism damaging and distressing and incredibly harmful to his reputation. But the High Court accepted the Mirror's defence that the column was honest opinion and found that Sir James could not prove that he had suffered serious harm as a result of publication. The UK businesses and assets of the failed electric truck maker Volta Trucks have been bought by an arm of the hedge fund manager Luxor Capital in a deal first reported last night by Sky's Mark Kleinman. Volta Trucks, which was founded in 2019, founded for bankruptcy in its native Sweden in October, with administrators appointed to its main UK business days later. Out of a total workforce of 850, Volta Trucks employed 600 people in the UK, many of whose jobs are now expected to be saved. And the Office for National Statistics said today that changes it is planning to make in measuring private rental prices would have raised the rate of inflation had it been used in the past. The ONS said the changes, to be introduced in March next year, would have raised the average annual increase in rents from 2.1% to 2.8% between January 2016 and October this year. It said that in turn that would have pushed up the Consumer Price Index measure of inflation from 3.4% to 3.5% during the period. Now, the British sportswear maker Castor, supplier to the England cricket team, F1 champions Red Bull Racing and football clubs, including Newcastle United and Wolverhampton Wanderers, has been valued at £950 million after receiving £145 million from a trio of new investors. Rain Group, the bank that's advising on the sale of Manchester United, and the venture capital firms Hanaco Ventures and Felix Capital joined Sir Andy Murray and the Issa brothers, the owners of Asda, as shareholders. The biggest shareholders remain the brothers Tom and Phil Behan, who founded the business in 2016. I've been hearing more from Tom.
We're really lucky, Ian, that we've been a very fast-growing business, but also very profitable. And my brother and I are from a working-class northern background. So even back in 2016, 17 and 18, where a lot of businesses were raising lots of money and not focused on profitability whatsoever, we were always very focused on profit, which gives you the privilege of choosing when to raise capital rather than having it forced upon you. We did feel now is the right time, where we not only want to have the capital to allow us to expand, we want to become a global brand, but equally importantly, to bring in genuinely value-add partners, which we're very confident that we have through this round.
Now, you haven't stated how much this values the business at, but reports have suggested it's around £950 million. You're not quibbling with that?
For me, as the founder, the co-founder of Castor, the valuation is really not that important. What's important to me is creating long-term value. We all know that valuations go up, down, sideways, often for reasons outside of everyone's control. I can control building a great business, building a great brand. If we do that, I'm very confident the valuation will look after itself. And
have you or any of the other existing investors sold shares in this, or is this all new money?
No, this is all about growth. For my brother and I, Castor is our passion project. We wake up at 5 o'clock every day. We spend probably too much time together. We think we've got a once-in-a-lifetime opportunity to build a British brand that competes on the global stage. This is all about growth. This is all about the future.
Are there any specific projects that you're earmarking for this capital to fund?
So there's a big focus on infrastructure. Castor competes in a land of giants. We are a speedboat in a market of oil tankers, so agility is one of our key competitive advantages. We'll be investing in our global supply chain to make sure that we're more agile than Nike or Adidas, any of the big brands in this market. And we're also investing in our technology platform. The sports landscape continues to globalise and it also continues to digitise. Castor will continue to be at the forefront of that, and this investment will allow us to make sure we stay there.
It's very interesting. I mean, obviously, you've got these two different revenue streams, obviously making and selling the kit, but also operating this online platform on behalf of third parties as well. How do the revenues split these days between those two?
So the revenue fluctuates depending on how we sign teams. If we go and sign a big partnership with a Red Bull Racing, the leading kind of Formula One team in the world, you'll see that number move, but then the brand will grow off the back of it. Again, my focus is on creating long-term value. The business model is highly synergistic. When we go and partner with a Red Bull Racing or a McLaren Racing, we help those guys better connect with their global fan bases and unlock value within that fan base. So that revenue stream will grow, but then our brand will grow off the back of it if those drivers are winning races, are on the podiums, and we get great logo visibility.
I mean, we've spoken a few times in the past. What's really interesting to me is the diversification between sports that you've been able to pull off. I mean, having started off with cricket and tennis, you've then gone into football, now F1. Which are the underserved markets there, do you feel?
The vast majority of the market is underserved. Nike and Adidas have had the global team sports market to themselves really for a generation. I'm 34 years old, and it's certainly for as long as I can remember. And in any market where there is a lack of challenger brands, there's a lack of disruption, you will see complacency. Tesla forced all the other car brands to electrify, to create those electric models. Castor is doing something very similar in the global sports market. The big brands focus all of their resources at the very top of the market. We are looking to help all of the teams that are ignored by those guys better connect with their global fan bases. There's a huge opportunity out there. It is a genuinely global opportunity, and that's what we're looking to take advantage of.
I suspect I know what you'll say to this, but I'll ask you anyway. Any plans for an IPO?
I mean, the IPO markets are clearly not in a great place. Again, my focus is on controlling what I can control, which is creating a great business, continuing to internationalise our business and our model. Once we do that, and if we deliver against the plan, having just completed this fundraise, there's no doubt whatsoever in my mind that there'll be a lot of opportunities out there for Castor, whether they're public or private, time will tell.
What a great story that is, a real success story in the world of entrepreneurship here in the UK. And apologies, by the way, to supporters of Mansfield Town, because I've trotted out all of those other great sports teams that Castor provide the kit to, and I didn't mention Mansfield, so apologies to them. And Bayer Leverkusen as well, if any of your supporters are watching as well. Well, still to come here on In King Live, we'll have a look at how the markets have finished the week. Don't go away.
Peter, and I'm Sky's climate change correspondent. The UK is a world leader in wind power. Power! Power! People! It's part of the Congo Basin rainforest, which is such an important ecosystem. It's known as the lungs of Africa. We aim to be the best and most trusted place for news. She doesn't really enjoy speaking to the press, and it wasn't clear right up until the last moment that she was going to sit down with me.
I might be just very naive, but I do believe that change is possible, otherwise we wouldn't be climate activists.
I'm confident for the last 30 years we have known how bad it is. I'm not here to apologize. I'm here to fight for the next step.
You can see just the piles and piles of stuff, these sofas and people's desks and children's books. And you can see inside this home here, people trying to sort out their home. It's just been devastating.
I think everything's at stake. The future of our planet, the future of the beauty around us, the future of you and me.
I just took a shower above the clouds. You know why? Because this is the Emirates A380.
Fly Emirates, fly better.
Well, global stocks, having enjoyed their best month for 3 years, appear to be continuing where they left off today. Here's a position in Europe at the close. All of the main European indices comfortably in positive territory. Talking points this afternoon include Worldline. The French payment services group is up nearly 6% in Paris on reports that the lender Crédit Agricole may take a stake. At one point, it was ahead by nearly 12%. We're here in London. The FTSE 100 has also made a winning start to December, having hit its highest level since mid-October, up 1% at the close. All of the leading gainers are the mining stocks. That's on the back of copper prices hitting their highest level since the start of September. And that, in turn, reflected manufacturing data out of China that suggested the sector has returned to growth. Well, among those leading percentage gainers, Anglo American, Antofagasta and Rio Tinto, all the leading blue chip gainers. Look at that, Anglo American up nearly 8% on the session. There are not too many FTSE fallers to mention this afternoon, but Tesco has fallen by just over 2%. That's on adverse broker comment. Outside the FTSE 100, you might recall this time yesterday we were talking about the latest profits warning from Dr. Martens, the shoemaker and bootmaker. Well, that's attracted a few bargain hunters after yesterday's sell-off. It's finished ahead by some 6.75%. To the downside, Ceres Power is off 9%. That's after the clean energy developer revealed an agreement with a new licensee that may not be signed. It also warned on profits. Over on Wall Street, well, the S&P and the Nasdaq both fell at the open on comments ahead of the US Federal Reserve Chair Jay Powell, but they've since rallied as those comments have started to come through. The Nasdaq, as you can see, is more or less unchanged right now. The S&P and the Dow are slightly higher. Among talking points this afternoon, well, Tesla shares were off 2.25% earlier on this afternoon. That's amid concerns over the impending launch of its Cybertruck, the touted price of which is some 50% more than the price Elon Musk had suggested back in 2019 when it was first unveiled. On the foreign exchange markets, well, the pound has hit its highest level against the euro since mid-September. As you can see, it's up 0.5% against a single currency. It's up by almost as much right now against the US dollar. Single currency and the greenback more or less unchanged, that pair. The oil price, meanwhile, has traded in a very narrow range today. The market's largely shrugged off yesterday's production cuts from the OPEC Plus cartel. Barrel of Brent crude currently changing hands at $81.18 a barrel. That's up 0.2% on the session. Well, joining me now is George Ligarius. He's chief economist at Mazars Wealth Management. George, good to see you this afternoon. It's been a very, very interesting half hour or so, hasn't it? Because these comments from Jay Powell have largely been interpreted as quite dovish. You think the market may be missing something?
No, I don't. Look, the Fed has been, a little bit wobbly lately in terms of its message. You have some Fed members who are saying, there could be more rate hikes. You have some hawkish members who are saying, now we're plateauing and we're looking at rate cuts. I think what is happening is that the Fed is trying to get its message together and through. And I think it's actually quite a simple message they want to convey, right? We're going to cut interest rates probably at some point mid-next year. We can't be too certain because there are geopolitical tensions that might affect supply-side inflation. So please don't price everything in as of today. And that's pretty much what they're trying to say. So sometimes comments might come a little bit hawkish, comment might come a little bit dovish. They're trying to find the balance because they're also looking at the 10-year rate. And what they don't want is for the 10-year rate to drop a lot on their comments, because then actually that might force them to hike.
Absolutely. It's a good point you make. I mean, we're having the same dilemma almost here in Europe. I mean, expectations for an ECB rate cut seem to have been repriced almost as we've been watching over the last few days.
Yes, well, inflation in the Eurozone is now, 2.4 to 0.5%-ish. And however, we need to remember that the ECB never hiked as much as the Fed and the Bank of England. So, when it's coming down from a much lower base. For what it's worth, I think that the Fed is going to move first, and then Europe is going to move, the UK included. And by the way, that's also what the OECD said in its outlook a couple of days ago.
That's very interesting. You think the Fed is going to cut before the ECB?
I think so, yes. I think the Fed is going to move first. The ECB seems to be comfortable where it is. I know inflation is dropping. It's nearly at the level where the ECB wants it. But let us not forget that we still have the possibility of a supply-side resurgence. So central banks want to be comfortable that this will not happen, and they need to wait a few months to see core inflation coming down a lot.
George,
well.
On the basis of that, looking at the sterling-euro currency pair in particular, does that mean sterling's slightly overvalued against the euro?
Well, I think so. I think the idea that, sterling is pulling up because they think that the BOE will cut after the ECB. I don't think that necessarily holds true. I think they both would cut at roughly a similar time, and that would be after the Fed. Now, I'm not saying, the GBP is necessarily overvalued, because it's not the only factor, but it is the main factor, yes.
And that's even despite the fact that some of the inflation data that we've had out of the Eurozone lately has been sort of certainly to the downside of what people were expecting.
Yes, but I don't think they will be enough to convince Christine Lagarde and a somewhat conservative German Bundesbank that has a lot of say in this. I think they'll want to see more.
Yeah, that's an interesting point you make. Now, what about the oil price? I mean, we had these production cuts yesterday from OPEC Plus. The market more or less shrugged it off. I mean, the oil price has ticked high this afternoon, but it's looking like it's a bit drifty right now.
Yeah, so I've been reading commentary from the likes of Goldman Sachs and Morgan Stanley this morning, and more or less they all believe that these cuts are sort of temporary and they're responding to a rise in inventories. So, inventories rose, and they didn't want to see the price drop a lot, so they just did the cuts to maintain the price close to where it is. So, in fact, if the price hasn't moved much, they're actually achieving what they set out to achieve in the first place, which is a stabilization of the price.
Very briefly, George, it's been a wonderful month, November, for equities. A little bit more to come in December?
Well, it's hard to say. I mean, equities have rallied a lot. Having said that, we did fully expect the Santa rally. The 60-40 portfolio, 60% equities, 40% bonds, is now exactly at 11%, which is historically exactly where it should be after a bad year. That is the average after a bad year, that 11%. So yes, you could see a little bit more because it has momentum. You know, I wouldn't expect another 10% in December, but going forward, because we still have quantitative tightening, we should be very careful.
Gotta go. Great to see you as ever. Thanks for joining me. That's it from me. I'm back on Monday at 11:30. Have a good weekend. Cheerio.